We got some sevens in there, some executors. So the question was, drop a seven if today you made some execution on something that was important that moved yourself, your family, your business, your finances. It moves something forward from something you executed on today. Drop a seven. All right, that's what I'm talking about. Some movers and shakers. All right, I got one extra. That was it. That was it. This is the reality, though. You know, missing these executors. So we'll give a couple minutes for those who are coming in, and then we're gonna slide it. We're gonna have some fun, get some great information flowing back and forth. We got a great partner, Vinny. He's gonna be sharing some awesome programs, awesome benefits that literally may serve you, or it may serve people you work with or partner with, etc. A lot of good stuff in store. All right, let's see what we got here. Let's see what we got in here. All right, we're loading up. We're loading up. All right, where my homeowners at? Drop a seven if you own a home. We're gonna test something. We're gonna start with some layers. Drop a seven if you own a property, an asset, real estate asset. All right, so we got one, two, three, four. Y'all count it out. Y'all got the chat for me, right?
Yes. Yes.
Yep. Yep.
Drop a seven if you own an asset, a real estate asset. Only a couple of y'all. All right, good. That's just room for improvement. That's all that is. All right. Drop a seven. We know where it stopped. Drop a seven if you own more than one real estate property. All right. Three people. Three people
Movers
own
and
more than one.
shakers.
Who's the shakers, the executors too, huh? Makes sense. It goes hand in hand. You know what I mean? It goes hand in hand. Well, those of you who don't have a real estate property, drop a seven if you want this year to be the year that you know you acquire your first asset. Rather a single, rather a multi, rather a flip. Drop a seven if this is the year you're like, yeah, I'm executing and getting my first asset. Or your second or third. All right, we got nobody ready to. All right, cool. All right, I was like, holy
Coming
cow,
in.
y'all on the wrong call, man.
You gotta give it some time, Jeremy. You know,
Nah, listen, executors,
a
what we
little
say?
breather.
No, we here, we moving,
Do it.
we moving.
A little breather.
You know what I mean? This is engaging. This is not throw it on speaker, walk away, go wash the dishes. You know what I mean? You gotta be present. All right, cool. So we're gonna slide into intros. We're gonna get this party rolling. So these are your partners here. Again, these are just individuals who chose to put time aside this evening to just give you some knowledge, right? Give you different ideas, strategies that are working, right? Strategies that are going to put you in a position to make moves that maybe you thought there were limitations prior. Maybe you thought it was just a traditional avenue of acquiring real estate assets or making a move. We're going to change the game on some of that, right? And introduce a different perspective and different strategies and some new programs that our partners have that are going to put you in a position to win. So start off with yourself, Jeremy, Brandon, with Thumbprint Realty. I'm excited to be here. I have two real estate assets. I've had others, and I'm excited to continue to learn of how to leverage real estate and how to acquire real estate and how to use it in as many forms. So as I learn that, I'm going to continue to pour that out onto those who I come in contact with and support. Next up, we can let y'all can just go fire off.
I'll go next. So I'm Clorissa McGregor, real estate agent with Thumbprint Realty. I'm also a homeowner, an investor. I got a couple of properties here in Massachusetts and also in Ohio. Yeah.
Hi, everybody. My name is Erica Davis. I am a real estate investor and a developer. I do own a handful of properties in the Boston area.
Handful.
Nice.
Jesus. That's like Skittles. You got a handful, huh?
Fire. Hi, everyone. My name is Kattia Ira. I am also a realtor with Thumbprint Realty, investor, hard money lender. Been doing this for the past 7.5 years, flipped and developed many properties.
Last but not least,
Vinny.
Vinny. This
You
is the
hear us, Vinny?
suspense.
I think
This
he's
is
frozen.
this is the suspense.
Oh,
He's
I think he's
building up the
frozen.
pipeline.
I
Nah,
think he is.
he's making sure everybody's present.
Vinny, you're frozen. He's frozen.
He went.
All right.
Yeah, he
Almost
just
got
got
him
kicked
Having
a
some
off.
message.
technical difficulties for Vinny, but we got Vinny Gregory with he's one of our lending partners with Salem 5. He actually has a phenomenal awesome program that they rolled out that really is going to help a lot of people make moves quicker, right, through this program. So I'm sure he'll slide back in and we'll get him rolling. Oh, looks like he's here. Ladies and gentlemen, he is here. Jumped out, got back in. That's what I'm talking about. You're still on mute,
Oh,
Vinny.
you're
I
on
know it.
mute.
He's leaving everybody in suspense right
So
now. I love it.
we'll do this again. So, hello, my name is Vinny Gregory. I'm a senior VP here at Salem 5 in the mortgage area. I've been doing in the lending business now for 35 plus years. Done pretty much every transaction out there. Grew up in the city, lived in East Boston for 30 years. So I'm a Bostonian at heart, and I'm happy to join the group.
Love it. Love it. Thank you, my man. All right. Let's get started.
All right, so let's talk about why we're here, right? So drop a 7 if you're a first-time home buyer. Give y'all a few seconds. All right. All right, so I can imagine that those of you who are first-time home buyers, you're here because you've ran into some barriers, or either you're nervous or scared about buying. So we're going to start off with some of the realities of trying to be a first-time home buyer, and then talk about some of those barriers and strategies you could possibly do in order to buy your first home. All right, you can go to the next slide. So first, what usually people try first, right? So some of the common pathways that first-time home buyers take, they usually say, I'll save more money. I need to make more money first, right? More income. I'll move out of Boston if you're looking to buy in Boston, or I'll move further away in order to afford something. I'll wait for prices to drop, or I'll buy on my own when I'm ready. But the problem with that is that keeps you stagnant, right? Next thing you know, 2, 3, 4 years have passed and you still haven't brought a home because of those barriers that we're creating. All right, next one. All right, so challenge number 1. When people say I'll save more money, the reality is rent is going up every single year, and that's eating into your savings. Home prices are rising faster than you can save. We all know every time we're trying to save money, what happens? Your car breaks down, your child needs something, and next thing you know, you're eating into your savings. Go to the next challenge. The next challenge. So I need to save more money. The reality of that is income growth is slowing down. You're not making as much money to catch up to the prices of home prices. Interest rates are also jumping quickly. Lenders are also capping at what you can afford based on those ratios, and we'll talk about that later on. Next slide. The last one. So I'll move further out. So moving further out, not only does it create a longer commute, but now you're also paying higher costs for transportation when you decide to move further away out of the city. Now you created more stress for yourself, your family, and the community that you want to be in, right? And as I mentioned, home prices are rising in those surrounding areas as well. We all know within a 20-mile radius of Boston, home prices are pretty much the same. So unless you plan on going out further past 20, 30 miles, it's not really going to make much of a difference as far as the prices of homes go. So that means you're trading affordability for the quality of life, right? And the problem with that is you got to ask yourself, are you really solving the problem, or are you just relocating it?
And that
Yeah.
brings us to strategy number one. And a lot of us were trained or exposed to a traditional way of purchasing, right? By yourself. Make sure your numbers look right or with your significant other, right? But outside of that, we're not really thinking more creatively outside of that, right? And this is where group financing and co-borrowing strategies are coming into play like hotcakes, right? As homes become more expensive, it's very challenging to stay maybe in the area you want to live or you grew up in. So you have to go further, as she stated, right? You're considering areas you probably never even been to, right? But that's the reality. But what others are actually doing is instead of trying to get their numbers to work, right? Their paycheck, their W-2s, get their debt down for themselves just to get something bare minimum, they're coming together because whether you know it or not, there's others just like you looking to make these moves, right? Rather acquiring a first investment property, acquiring a single family, acquiring a flip. So how do we take this want and eagerness and take it to the next level? Right? This is where you start pooling capital. Right? You really find and you have to be strategic. So on here it says buy with family and friends. Very important piece we're missing. Buy with trusted family and friends, right? And there's a vetting process. Buying and acquiring a real estate property, don't see it as emotional. Like when you are bringing another human in here, it is going to help your leverage, meaning your capabilities. Before you were probably able, let's just say, for example, let's say you were able to purchase a multifamily and your limit was only, let's say, 600,000. But you and Johnny together, now your buying power, right? What you're able to afford is now 1.1 million together because it's not only looking at your income and your debt. Now it's looking at you mixed with Johnny. Let's say you have high debt because you got an auto loan that you took on. That's it's like $800 for that and some credit card debt, but you make good money. Johnny has no debt. He has good money as well. Now you guys together, you have higher income, you have lower debt that's holding back your monthly obligation, and now you can afford more house. Johnny wants to buy a multifamily. He wants to buy a home and get out of his parents. You do. You guys can buy a three family. He lives in one unit. You live in another unit, and you all rent out the third unit. Right now, you have an option to have someone else help you all pay the mortgage. Right, and this helps your debt to income. This helps all the other challenges buyers are seeing and facing. But you do have to do your due diligence in the beginning to vet who you make that decision with. Don't just do it with your cousin. Don't just do it with your brother. Don't just do it with your mother. This part matters, right? And be honest, you should have an operating agreement or set up a LLC, LLP partnership or some form of a structure just in case things go sour. Everyone's held responsible to the same avenue. So we're going to get into some other strategies and programs that go over this, but this is a big key that is exciting people on a whole nother level because it opens up the doors and removes people who are on the sideline and allows them to get back in the game. Allows them to get back in the game. So I'm gonna pass it over to my man, Mr. Vinny, Salem 5.
All right, thank you. All right, so as we've been learning, co-purchasing. It's a program that the city of Boston offers, and the next few slides are going to go over that basically with you. So we're going to talk about underwriting, we're going to talk about structure, and we're going to talk about the advantage of using a local lender compared to a national lender. All right, so you'd be kind enough to go to the next slide. Can I do that? Do I have the ability to switch to
Jeremy. Oh,
Okay, perfect. All right, so the city of Boston about a year ago came up with the idea of a co-purchasing program. Now, I will tell you, in mortgage lending, it's a copycat business, right? So this idea has been out in the West Coast for a few years now, California especially. With the prices of homes out in the West Coast, it became a challenge for people to buy houses, just like it is here in the city. So the city of Boston looked at all the different programs available through the country and decided that this was the best approach for the city. Basically, what this does is this allows, as we've been talking about, family members, siblings, parents, friends, business partners to be able to go in and purchase a home together, take the advantage of combining your income to help offset the higher prices in the city. And it also set up to help you with your down payment, right? Because when you buy a home, you have to have at least 5% down. And when you're buying in the city, if you're buying a two-family or a three-family, you're talking sales prices ranging anywhere from, say, 850,000 to 1 million plus, right? And 5% is a pretty hefty number to come up with. So the city realized that, and they created this program to kind of help offset that to make it more affordable for everybody. So as you can see here, some of the bullets, right? It's based on medium income. So every year, every few years, the government does a census tract, and the reason why they do their census bureaus is to determine how many people live in this communities, and it also determines what the average income is within the communities. And then we use those numbers to create these type of programs. And it also talks about down payment assistance. And what you're going to see in the next few slides is that depending upon your percentage of income for the area you're buying in, which would be Suffolk County, that would dictate how much money the city of Boston is going to give to you in the form of a down payment assistance grant and closing costs. Okay. If we go to the next slide. So what we're doing, what we're doing right now. So the program supports, let's see, the support households who don't qualify for affordable mortgage products and together have combined income that exceeds at least 135% AMI. So what the city has decided to do is that they're going to treat each individual as a household. And what I mean by that is if you're buying a two-family, and let's say you're buying it with a sibling, you're going to live in unit one, your brother and sister is going to live in unit two. They're going to look at unit one and they're going to look to see how much money you earn. That is a household. You'd be a household of one if you're a single person. If you're married with children, it could be 2, 3, or 4 in your household. That number is going to then dictate how much money you can make within the city. And that's how they determine how much money they're going to give you for your down payment and closing cost. So in this example, it talks about down payment amount of 5% for each household share. So what they mean by this is for easy math, let's say you're buying a two-family for $1 million. Each unit, if you're splitting the property 50-50, 500,000 for unit one, 500,000 for unit two. Unit one's 5% down payment would be basically 5% of $1 million, which would be what, $50,000, right? Is that my math right? Or 25,000? Let me see here. Give me 1 second. So it'd be $50,000 would be your portion of down payment. Unit two would be 50,000 because it's equal ownership. The city is going to require that each unit owner put some money into some down payment money out of their own pocket, and the city will pick up the difference for you. And we'll get into that in a few slides down the road. They're also going to pay your closing costs. When you buy a home, not only do you have to pay your down payment, you have other fees. You have the attorney's fee, you have the appraisal. We have to do title search and rundowns to make sure that all the transactions in that property's history were done correctly. We have to go to the city and get the municipal lien certificate, which tells us what your taxes are. Everything costs money. So that would be your closing costs. And the city realizes that, and they'll also help pay that for you. Okay. So in the next bullet down here, it talks about the two different numbers that they're using. If you have a household of one or two, and let's say you fall within that 100 AMI number, they'll give you up to $50,000. So what does that 100% AMI number equal? That equals about $125,000 a year, 100 in that range for earnings for that individual. So if you earn within that number, they're going to give you up to $50,000 for your down payment and closing costs. Then if you earn over 100%, but you're under the 135% number, they're going to give you $35,000, right? So they figure you're earning more, so you may not need as much help as somebody who's earning less. So that's why you see the two differences. Okay. I'm not sure how you like to do it. Usually I may just open it up and see if anybody has questions on that and then kind of go to the next slide.
Does anybody have questions on that?
Don't be shy. Feel free.
You can
You
just
also
come
put it
off-
in the
come
chat
off
if you
mute
want.
or put it in the chat.
All right. If there's no questions on that slide, we can go to the next slide. So eligibility, what makes you eligible for the program? First, most importantly, this is a first-time home buyer program. You have to be a first-time home buyer. The definition of a first-time home buyer is somebody who has not owned a piece of real estate for the past 3 years. Okay? So if you owned a home back in 2020 and you sold it, you would technically be considered a first-time home buyer. We do have a question. I was going to ask if this works for anyone receiving government assistance. It's a good question. I will get that in a second, but yes, government assistance is acceptable. It's an acceptable source of income. Okay. You have to contribute at least 1.5% of the sales price. Again, remember, $1 million home, 50-50, $500,000, $500,000. You have to have at least 1.5% of your $500,000 in the transaction. Same would go for unit 2. Okay. So between the two households, they would be contributing 3%, and then the city would kick in the difference. Okay. You have to agree to live in this home. This has to be your primary home. Now, like anything, life changes, right? Life goes on. You may look to live there today. A year from now, 5 years from now, you may decide that you want to leave. You can do that. But, you got to remember when you leave, there's another person that's involved in the transaction. And I'll get into that piece in a few minutes. But you got to keep in mind, there's another party involved. So you got to set things up correctly in the beginning. So that way it allows you, if you decide to leave down the road, to do so. Okay. Let's see. Must co-purchasing be split
That's a good
50-50?
question.
It's a very good question. It doesn't have to be. I always use the 50-50 just for easy math, but you can have it set up where it's 60-40, 70-30. Okay. Now, when you set up your percentages, there's a document that we're going to talk about in a few minutes called the co-purchasing agreement. Okay. So this is kind of a document that you create, and the lawyer will help you with this. And you basically would go through percentage of ownership and all kinds of other things that would come up during the homeowner process, right? So if you decide that you're going to take a 60% interest, that just means that you may have to contribute a little more than the person who's putting in the 40%. All right, but that's a very good question. Okay. You have to have, there's an asset limit.
Yeah.
You have to have less than $100,000 in liquid assets. If you have a 401k, they do not count 401ks. If you have a Roth IRA, because of tax purposes, is considered a liquid asset. So that would have to be included. If you're getting gift funds, and gift funds are acceptable, again, as long as you have 1.5 of your own money, you can get gift funds for anything above that number. That would also be included in that $100,000 asset test. Okay. And then we'll talk about the co-ownership agreement. So the easiest way to kind of explain this is that you're buying it. I think you mentioned LLC earlier. So an LLC kind of sets up the rules, the guidelines as far as percentage of ownership and how you're going to maintain and manage the property. A co-ownership agreement is very similar to an LLC. Okay. In the mortgage world, you can't close loans in the LLCs. You do those transactions after the fact, after you close. But in this particular program, you have to have an agreement which basically will outline your ownership percentage. It would talk about what happens if one person can't pay the mortgage 1 month, right? Because you got to remember, when you go into this, this is a partnership. So, your mortgage payment is $5,000 a month. You agree to split it 50-50. That's $2,500 a piece. What happens if the person on the second floor doesn't have the money that month, right? It is a mortgage given to two individuals. So if you don't make the payment, both credits will be hit with a 30-day late, right? So this is why you have to have a co-purchasing agreement, because you have to prepare for things like this. Because I said earlier, life happens. Maybe somebody unfortunately gets laid off. Maybe there's some medical expenses or personal expenses that come up that they have to take care of, which takes it from the ability of making their mortgage payment that month. If they lost their job, what happens if they can't make 1 or 2 or 3 months worth of payments? This is all built into that agreement. The city will not let you move forward with the program unless you have this agreement in place. That's how important it is. It's probably the most important part of this whole entire process.
Which is
Any
actually a
questions?
huge plus.
Yeah.
There was a second half of that question. Do both co-purchasers have to stay in the property?
Yes.
And then also someone raised their hand as well.
Yes.
So if one moves out, the other has to move out, or
If one moves out, then the city would be notified. And on see, this is where it's a little tricky, right? In the mortgage world, as long as you're in there for a year, that's the minimum typically requirement for somebody in a primary home, right? We like you to be in there longer, but at least a year is the minimum. If somebody left in a year, for me, it doesn't make any difference. For the city, it does. So, because the city is giving grant money based on that person living there for a period of time. So, what the city may do is they may look at how long you've been in there. They may prorate your portion of the money that they gave to you, and they could ask you to reimburse them for the difference. Okay. But on the mortgage side, if somebody leaves, as long as the payment's being made, typically, that's why when people buy multifamilies and then move on a few years down the road in singles, they don't come and tell us because we would say, oh, technically it's an investment, so you got to refinance it. It's just not done that way. In the
It
perfect world, I
doesn't
guess it would
happen.
be,
That's
but it
why
doesn't.
people
It
don't
doesn't
do
happen.
that.
It doesn't happen.
All right,
But
we have a
yes,
question here. All right, let me see. You can hop off mute.
Hello.
hi.
Hi. Thank you. Um, so for the co-purchasing agreement, to your point, you can come to an agreement, but if the next person is not unable to make the mortgage, their half of the mortgage for 2 to 3 months, is the co-purchasing agreement to save my credit score and all that? Or is it just like, what's the outside of the agreement, but circumstances happen?
Mhm.
I'm sure I'll have savings to hopefully make up for it, but what is it actually protecting outside of course, the agreement that it's a co-purchasing? Pretty much, does someone's downfall fall on me?
It does.
Mm.
It does. It really does because again, the mortgage is given to both of you. All right. So there's no way in the mortgage side of it for me to say unit two is not paying, unit one is. So I'm only gonna mark unit two late, not unit one. It just doesn't work that way. So
That's
if
stressful.
that's the difficult part of it, right? So now what are some of the things that you can do in the co-purchasing agreement, right? You can put in there that maybe, and this may not be a bad idea, kind of treat it like you would treat a condominium, right? Condominiums have association fees. Now, you're not going to create an association or anything like that, but maybe you create an account and you kind of have a little rainy day fund between the two unit owners that you put a little money aside into that fund. So that way, God forbid, somebody ran into a problem, they can tap into that account for their share to make up the difference. Not saying you have to do that, but may not be a bad idea to do that. Same goes for repairs, right? If you have repairs that need to be made in the house, again, whose percentage of ownership, who's going to be responsible to pay the biggest share if it's not 50-50, if it's a 60-40 split or whatever it may be. So again, I think the attorney will sit down and the attorney would go over all this with you. So that way, when you leave that room, everybody's and has an understanding of what's expected of them. And there's a game plan on how to handle it if, God forbid, something happened.
Yeah, we got a question too. Uh, so from Monique, she said, "I heard LLCs mentioned, but can you do this program under an LLC?"
You cannot. Okay. The programs that we're going to be talking about are traditional mortgage programs, which would be, you probably heard these names: Fannie Mae, Freddie Mac, FHA, Federal Housing Associate Authority. They do not allow LLCs for closings. LLCs allow you to kind of hide behind the company and it kind of takes ownership away from the individual and puts it into the corporate name. And these mortgages are given to you as individuals, not as corporations.
So let's say someone did this program, right,
Mhm.
together, and then a year or two later, they chose to change the deed to an LLC.
It goes back to what I was saying earlier.
Got you. All right.
It's mortgage lending. There's a lot of the honor system.
Yeah, got you.
So does it happen? It happens all the time. Just like when somebody buys a home and a few years down the road they put it in a trust. Should they put it in a trust? Technically, no, but I
But
mean,
would the lenders allow them to put it in an LLC, or would the mortgage be due on clause? Would the whole mortgage be due? Because you can typically transfer over to the trust and the mortgage is not due.
well,
But
technically it should be.
Yeah, if you transfer over to a LLC.
Are you in a trust because you're breaking the covenants of the mortgage? So if you transfer it out of your name as an individual and into any other entity,
Mhm.
technically you are breaking the terms of the mortgage agreement that you signed at closing,
Unless the bank approves it.
unless the bank approves it. So
Yeah.
you could always reach out to your lender and you can ask your lender, say, this is what I want to do. And then they can review the type of mortgage that you have. And then they can make the determination if they're going to allow you to do that or not.
How often do they recall mortgages because someone switched the name to a business or a trust? Do they do that often, or is that
I
just
don't think it's done. I don't think it's done that often.
yeah,
I mean, there's a lot of things that, in the mortgage industry, you give it to two individuals and God forbid somebody passes away, right? That we never know.
yeah,
I mean, I guess there's been cases where both parties have passed away and the kids just keep making the mortgage payment. You know,
yeah,
it's
yeah?
if it's paid on time,
You got
honestly,
hundreds of
nobody ever
thousands
looks
of
at
mortgages. No one's
nobody
looking
ever
at
looks
each
at it,
file. Yeah,
right? I mean, as long as the payments are coming in, there's nobody in the back room every month trying and going through all kinds of mortgages looking for
yeah,
who's actually doing it.
yeah.
You know.
Yeah, and just for those who came in late, right now we're talking about a specific product that Vinny has with Salem 5. And the whole topic of all this is purchasing a home beyond just the traditional of you by yourself, right? Because there's limitations, there's hurdles. We're talking about group financing, we have products and ideas, right, that support you coming together with a responsible another person or persons and actually being able to do some good damage in real estate and acquire some assets, or even get your foot in the game if it's your first one, right? Strategically versus it all being on your shoulders, it all being on your income, your debt to income, etc. So I haven't even hit the next one, right?
Go to the next one.
All right.
Eligibility
Well,
criteria, products. So it's just kind of talking about. So, you see here that the slide talks about fixed rate CRA portfolio loans from private banks, conventional loans from Fannie Mae, Freddie Mac, Federal Housing Administration, any other loan programs approved by the city of Boston at the Home Center. So let's talk about the first bullet. CRA. CRA is Community Restoration Act. It was passed in the 70s. It's basically a law that says that banks have to lend within the communities that they serve. So Salem 5, who I work for, we have 32 branches. We have a branch in downtown Boston across from City Hall. We have people who deposit there, right? That bank has a deposit value. And by CRA requirements, we do lend back within the community based on the overall percentage of our deposits. It's a national thing. Every lender has to do it. Some lenders do it certain ways. Some lenders have different approaches to it, different programs that they create, depending upon if they're meeting their CRA goals or not. So this program would be considered a CRA program. And what really makes it a CRA program, it's not the first time home buyer piece, right? That helps. It's the location of the property, because again, it goes back to the census tracts, the census bureaus that the government does. They have certain areas where they designate as CRA markets. So based on where you're buying a home, you can have a home on, I grew up in East Boston. I lived on East Eagle Street. I could have my side of East Eagle Street be considered a CRA area, but across the street from me may not be. That's the invisible line that goes down the street. So there's that. That's a way that you get CRA credit. The other way is you use state programs like Mass Housing Partnership, or the One Plus that you may hear about within the city. Those are CRA programs. They're special programs created for first-time home buyers based on your income. Fannie Mae, Freddie Mac, they also have their own versions of first-time home buyer programs. They call it Home Ready and Home Possible. They base it on income limits, just like everybody else does. FHA, they really don't have a CRA component to it. If it's in a CRA zone, it's a CRA loan as far as FHA is concerned. What's the importance of a CRA product? Typically, it is a lower interest rate, reduced mortgage insurance, because if you put less than 20% down, you have to have private mortgage insurance. So CRA loans get a lower rate for private mortgage insurance. Basically, it's to save you money. Okay. Other loan programs that the city offers, I guess the only other thing I would say that the city of Boston or the Boston Home Center allows for their down payment assistance piece would be non-warrantable condos, which is really not what we're talking about. But if you had a condo and it didn't meet Fannie Mae or FHA or Freddie Mac requirements, there are programs, we have them, that cater to that type of transaction. The city realizes that and they don't want to penalize people because of the association may not be approved by the, Fannie Mae or Freddie Mac. So that's kind of an exception. They'll let you do those loans in their programs. Okay. Any questions? Okay, we're gonna go to the next slide.
All right, cool. We're gonna
There you
slide over
go.
to Miss Kattia. It's a good fun one right here.
All right, guys. So, house hacking. Does anybody have a sense or an idea of what house hacking is? If you do, drop a 7 in the chat just to get a feel of who knows about house hacking. Teresa knows it. Awesome. All right. Only Teresa.
Let's see. Let's see who else
Okay.
know. I want to see who else know. We gotta have more than one person know.
Uh,
She said,
I think that's why they're here.
Listen,
They're like,
I'm gonna be
okay,
curious.
Monique does. Vinny does.
I'm gonna learn
Okay.
about this. This is good.
EJ does.
All
Okay.
right, bet.
All right, we got a good amount of people. All right, so basically, house hacking is purchasing a 2 or more multifamily. Some people even do it with single family homes, but because of the topic we're on today, 2 to 4 unit multifamily. So if you purchase this multifamily, you can even do it based off of the program that Vinny just touched on, or even FHA, conventional. You purchase that property, you live in the unit, and you rent out the other 2 units. And based on the amount of work that's needed on the property, some people tend to owner occupy the unit that needs the most work sometimes so that they could renovate it, make it their own, and build equity that way. In light of that, as you are doing renovations to the units, therefore you're building equity. So let's say you purchase a 3-family, the other 2 units, they have tenants in them, you live in the unoccupied unit, you renovate it, it looks beautiful. You have your second floor tenant, let's say they purchase their own property, you move up to that second unit, you do the same thing, whereas that first unit you renovated, now you can get top rent for it, and build a lot more cash flow for yourself. So you just keep doing that with all the units. And there you go. Some people, it could take them, less than a year to actually build equity on their property that way, more than, let's say, if they waited 2 to 3 years later on down the line. So this is a great, great strategy to be able to get into. Just make sure that once you guys are doing the projects, you are pulling permits, ensuring that the work is done strategically. You can even pull equity out of the property after you've renovated that very first unit and use it to do the other 2 to 3 units to actually get your property from a, let's say, $600,000 property that you bought to $1 million. So that is house hacking. And Jeremy will go on to the next slide. All right, strategy number 3, you have the renovation play. This one, similar to house hacking, but this one has different types of financing that you could utilize for this. There is also, if you do want to go the FHA route, there's a FHA 203K loan that you could do, whereas the bank will fund the funds that you need to renovate the property. That one entails, of course, you have oh my goodness, why am I drawing a blank with the name of that person that comes out to make sure that from the bank, they come out to make sure that the work is being completed in a timely manner. It's being completed up to code. because the bank wants to make sure that their asset is also protected and that permits are being pulled. Of course, they send their own, my goodness, Jeremy and Erica, help me with the name. Say that again.
Inspector?
No, not the inspector, specifically for the 203K loan.
It's a housing consultant.
Yes, yes. So for the FHA 203K loan, you have a housing consultant that will come on site to oversee that the work is being done to standard. But we have another option, which I am much more familiar with, that I do myself, which is flipping the property. So you purchase a distressed property in a neighborhood, let's say in Milton. You find a property for 300,000. I'm throwing that number out there. I wish I can find a property for 300,000 in Milton. It needs about 200,000 worth of work. And once you've put in that 200,000 worth of work, that property is worth $1 million. So that type of strategy is normally done through hard money lending. And hard money lending is private money. It is considered cash to a seller. And of course, we all know that sellers love cash. They do a quick close. So you could close within 2 weeks when you go through the hard money route. The only thing is with hard money, you have to have a higher down payment, which is typically 15 to 20% down on the purchase price. They have 3 points that they charge, 2 to 3 points. And also they give you a 1 year term and the interest is higher. So typically it'll be around 9. It could go as high as 12% interest when you go through a hard money lender, because it is considered hard money for a short amount of time, whereas they give you 100% of the financing, you're putting the work into this property, and you're building instant equity. A lot of investors like to go that route, or a lot of folks like to go that route in order to build liquid cash to be able to purchase, let's say, a multifamily down the line, to work on their credit, pay down debt. So they use that as an option to be able to go and purchase property further down the line. So again, we find the worst of the worst properties and renovate them, have the right team, have a general contractor, have your architect. If you need to get a engineer involved, of course, you get an engineer involved as well. And you build that property up, you renovate it, and you make the cash and be able to keep going that way. I don't know if you guys have any questions on that renovation strategy. Please feel free to put it in the chat or raise your hands.
Yeah, and the good thing, just to add on to what she's saying, this, if it's your first or even second, this is an appropriate play to consider the co-borrowing process, right? This journey, there's a lot of money to be made, but there's a lot more money to be lost. It really is. And it comes with a lot of hurdles, pivots, things you didn't see, delays, which cost money. And again, when you consider buying or collaborating with someone who's responsible, who you trust, this actually makes this journey a higher chance of success. You're splitting the expenses, you're splitting the exposure, you're splitting the stress, you're splitting everything it takes, right, to purchase, to maybe acquire, build up funds, or even your own home. Because you guys may find like she said, an off-market deal that needs work. You buy it with someone, y'all flip it up. Let's say it was a multifamily or a big single that you're converting to a two-family. You buy it together, flip it together, and then you live in one and the other person lives in the other. Now you have a property with a whole bunch of equity that y'all are both owning together, splitting the expenses on that journey. So just tying that all back together for the co-borrowing piece.
And then just to touch on that too, I know someone had a question about co-borrowing, if they can purchase it under the LLC. You cannot, but with hard money lending, you can purchase it under the LLC. And again, if you're coming together with partners, ensuring that you have an operating agreement.
Heck
An
yeah.
attorney has looked at that so that everyone is on the same page. So you got to protect yourself. When you're
Have that
doing this
agreement.
type of risky, yeah, it's a very risky route. But of course, the higher the risk, the better the return most of the time. So, you know, just make sure you're doing it right.
Yeah, but it's a phenomenal strategy, phenomenal tool. Again, it's just another way to get in the game of real estate without having to solely rely on what you're capable of financially or credit wise, etc.
Mhm.
All right, cool. We're gonna next slide in the biggest.
Thank you,
Uh,
Jeremy. Thank you. Thank you.
so there was a question in the chat.
Let's see.
Hard money lending.
So Katia, she's
Yes,
asking
hard
hard money
money
lending.
lending, it is private money. So pool of investors that come, you have access to those funds. It's not typical financing, so it's private money that you can borrow. And it's all based on the numbers. So with the hard money lender that I work with, credit is not a factor. They don't ask for bank statements. Some lenders, hard money lenders, in order to get better terms, they want you to be at a 650, 750 credit score, and they ask for income documents. But for the one that I work for, income and credit is not a factor. As long as the deal makes sense and they see there's money to be made there, that's fine. And then, of course, some folks, they do refinance and just hold the property. So you have the capability of refinancing and holding it. So it's short term money.
Yeah, the one thing I would say about that with hard money, definitely do it with someone who's familiar with either
Yeah.
flipping or hard money. It's not, if you're a first time home buyer, I wouldn't recommend it. There's so many programs out there to use your first time home buyer benefits from. But if you find a house that does need work, there's so many other programs, 203K loans and so forth. Um, so yeah, that's the only thing I would say about hard money. It's not for beginners.
It's a great tool. Again, like she said, you can partner with, right? That's
Mhm,
you all getting creative. Get with someone who's experienced and know your
mhm,
numbers. Talk about the worst case scenario in the beginning,
mhm.
so that way you're prepared.
Okay.
All right, so
Yes.
we're gonna slide over to Erica, and she's gonna hit off some of the awesome programs, honestly, that are out there that are available to a lot of people.
Yeah. So most people think they need the bag or like 20,000, 30, $50,000 to purchase a house, but there's programs out here that help you purchase homes with minimum money down. And I'm going to share a few of the programs and I'm going to also pinpoint how I have helped my clients. And a lot of us on here has helped our clients with a lot of these programs. So NACA, I purchased my first home with NACA, and this program's one of the best out there because they don't require you to put no money down. There's no credit score requirement. There's no closing costs. There's no PMI. And the reason why I like this program is because if you don't have a lot of savings, well, you don't even need a savings. So they're not even going to require for you to have 10, 15,000 down, right? They're really strict about you managing your money while you're getting pre-approved. So they are managing you to make sure that you are doing what you say you're doing. So if you say that you spend $50 on gas, your rent is $2,000, you have insurance. They're just looking and at your bank account to make sure your funds are going where you say it goes. Now, if you're not following the plan that you told them, they will halt you and say, okay, you really need to put together a different plan or you need to hold yourself accountable. So that's really their one of their major requirements. But other than that, you can go to the closing table with no money down and you could buy down your interest rate. And NACA's interest rate is always lower than the market. So if today's interest rate is about 6.5 or 6.8, they're going to be around 5.5 or 5.8. So a lot of people definitely uses NACA, but again, they are requiring you to stick to the plan that you put together. BHA, any questions about NACA before I go to the next one? Or has anyone used NACA besides me on this chat? You can drop a 7 if you have, or if you have any questions, feel free to ask any questions. Is there any questions in the chat or no?
Someone just asked, can you use your property for profit? I'm assuming you mean, do you mean can you sell it for profit? What do you mean by that, Janae?
Because technically you can, right? If you buy a multifamily,
Well,
you are
she
making
could be
money.
talking about rental.
Yeah, because you are making money.
Yeah, can you specify if you mean as a rental or
Yeah.
okay, more like renting?
Yeah, you could purchase multifamily. You could purchase a 3-family. You could purchase up to a 4-family with NACA, and you could live in one unit and rent out the other units. You are required to occupy the property, so there's an owner occupy requirement. Did that answer your question? She's good, guys?
She's good for
I
now.
think so. Yep.
So Boston Housing Authority has a program where if you are a current voucher holder, you can use your voucher to purchase in the city of Boston. And they are giving you up to $75,000. You can purchase a single family or a condo and still keep your voucher, and they will subsidize your mortgage. So your voucher, so they typically have a percentage breakdown, like when you're paying rent, like it's like an 80-30 split. They have the math that they do to subsidize your mortgage. So you are able to still keep your voucher up to 15 years. But again, it has to be a single family or a condo. If you purchase a 2-family, you do get the 75,000 down, but they are not allowing you to still subsidize your mortgage. And you can couple this program with the Boston Home Center and get some more down payment assistance. Does anyone have questions about this program?
Yeah, so she also asked, can you use this for profit? So for renting, for if you're a voucher holder, can you also rent out one of the units and live in the other?
So yes, if you purchase a 2-family, you can live in one of the units and rent out the other one. But the only caveat is when you purchase a 2-family, your voucher is not subsidizing the mortgage. They would only allow your voucher to subsidize the mortgage if you're purchasing a single family or a condo. And you can hold that voucher for 15 years.
Does that
And
make sense? Yeah, she said okay.
Can I just add something to that? That's
yeah, go
okay.
ahead. Yep.
So if you're going to use that, that's perfectly acceptable. Just make sure that whatever lender that you're dealing with, you let them know what you're looking to do, because certain programs allow it, other programs don't allow it. So you need to make sure that they're putting you in a product that allows you to use the certificate.
Yeah,
And
and just to add to that, when you're speaking to a lender, if you are going to buy a multifamily, just be careful with your words. Don't say it's going to be an investment property. There is a requirement that you have to own or occupy the house. So you have to specify that you're going to own or occupy the house and obviously be renting the other unit. Someone else asked, are there housing value / lending caps on these programs? Erica, are there any caps on any of these programs?
like income caps.
Yes.
Maybe
So
even
yeah,
caps for purchases.
Or housing
It says
value
home value. So is there a limit on what the house is valued at?
or like how much you could purchase, what you could
Yeah.
purchase. It's based off of what you're pre-approved for. So there is an income cap for a lot of these programs where you can't have a certain amount of money. Well, NACA doesn't have a cap. You can make as much money you want, and you can have, well, they do have a cap of how much money you can have in savings, but there's no income cap. For BHA, there is an income cap and there is a asset cap.
So they said house value. So it would be based off of your income and what you can afford. That's how a lender determines um, your pre-approval amount, if that makes sense, which is the house value.
And if
Does
you
any
want,
What would be so
we
what
can
would be
talk
that
about
max
that.
then? Yeah,
Let's
what
say
would
if
be
you
that
want,
max? Like, is it I gotta make if I make 150,000, that gets me X, Y, or
I mean, there's different variables that go into that based off of, if Vinny can answer, I'll let him answer.
yeah, there are, and if you want, after you're done with the slides, we can probably take a few minutes and kind of talk about how does somebody qualify for a loan and how do we come up with the numbers that we use.
Yeah, that would be nice if we give them a breakdown.
Yeah, we can do that.
Cool.
Next one.
Thank you. Okay, mass housing. Mass housing does have some down payment assistance, and you can get up to 25 to 30,000. And I have helped a few clients, and we all have, received some down payment assistance. And the great thing about this is you can, when you're working with an agent, they're going to know these programs, especially if you're working with one of us, and we can share the programs with you and connect you to a lender such as Vinny, who is well-rounded in these programs, and he can definitely give you more information after he reviews your taxes and all that good stuff of what program will best fit you. So every program won't fit you, but there is a program that you can utilize because you may not have a BHA voucher, right? You may not want to live in Boston. You may want to live in, on one of the outskirts cities. So you want to do a one plus mortgage, the one mortgage mass program where it allows you to still get some down payment assistance. You can couple that with the mass housing down payment and you can purchase on the outskirts. So you can go Brockton, you can go Randolph, you can go those locations. So sometimes it's really most of the times it's really about the individual. If you don't want to live in Boston, then you need a different type of product. If you want to live in Boston, you can use the One Plus Boston, right? And that program allows you to live in Boston. You can get some down payment assistance from the Boston Home Center. And the great thing about the One Plus Boston is they have a lower down payment and you can use the down payment assistance from the Boston Home Center so you won't have to come to the closing table and there's no PMI. So every program, not to complicate things, every program has different offerings. You really just want to learn about each one and see which one would be the best fit based off of how much you get pre-approved for it based off where you could afford to live too because sometimes you feel like you're priced out of Boston and you don't see a house that you like. So you want to go to the Randolphs or the Brocktons or the Stoughton's, and there's other products that would best fit you.
Can you do group financing with this?
Which with
Either of these programs that you talked about so far?
Yeah, you can couple it. So you can couple the one mortgage with the mass house and down payment assistance program, and you can take the one Boston program and use the Boston Home Center. You can use some of that down payment assistance with
Sorry,
that.
I meant like can two, like to say two or more, let's say if me and two other people decide to buy a house, can we, two or three of us use these programs to acquire a property?
Like what the program Vinny was talking about.
Well, no, I'm talking about the ones you referenced.
No, you can't
But
So these are all solos.
Well,
can't use NACA and say, hey, me and you, unless we're doing our taxes together and we're married and all that good
Gotcha.
stuff, and same thing for the VHA. It's not like the Vinny's program where two people can partner together and purchase.
well, it kind of is.
So different people, different household, just tax returns can purchase through NACA.
Well, not through NACA, but on the mass housing and the one mortgage, you could have two individuals who want to just buy a house together.
Mhm.
It's a single family and it's considered household size. So you
So
have
they
two
live in the same
individuals,
house currently.
they're in the same
Yeah,
house.
yeah,
So you
yeah.
have your household income limit. So you'd have to figure out how many people live in the house, and then that will tell you what the income cap is.
But they
But
can't currently live in separate houses. They have to be
yeah,
currently live in the same house.
there are ways.
Okay.
There are certain things come up where maybe they never live together, but they want to live together. I mean, there's a possibility of doing it as long as their income doesn't exceed, that household number. There are some ways to do it.
Okay, so you're gonna finagle it.
Well, I won't call it finagling it, but there's ways because every deal is unique.
Yep.
So as long as it makes sense, that's a lot of, yeah. As long as it makes sense, you can do certain things. Yes.
So can you share a little bit about it? That's what's it's in the chat.
Sure. So, basically, the co-purchasing program, that one is two separate units, right? So that's a two-family or a three-family. Well, kind of what we're talking here is that you could have siblings who just want to buy a two-bedroom or a three-bedroom single family and live together. You can certainly do that. You could have um, friends. You can have a parent go on it with you. I mean, there's different ways. A cousin, right? You can decide that they're going to live together, and it's cheaper for them to live together and buy their own single family than it would for each one to rent on their own. So there are some cases where it kind of makes sense for the transaction. Now, if they live in different state, I mean, there's all kinds of stuff that you kind of look at it, but
Yeah.
it is possible because in mortgage lending, I mean, we do have programs that allow you to have non-owner occupant co-borrowers or co-borrowers in general. So it kind of falls under that whole definition. So I guess it's unique in case by case, but it could be done. Does that help? That
Yeah.
might be more confusing.
Yes, thank you.
No, that was great. Thank you. All right, Eric, I switched page for you already.
Okay. I explained these two already.
Okay, got you.
Okay, so City of Boston has Boston Home Lotteries where you gotta fill out an application, and if your application gets selected, you get to move in a affordable unit. And about a few years ago, the Sage on Boston was a listing that Thumbprint had, and it was an affordable unit. It is deed restricted. It was deed restricted and it still is deed restricted. But the great thing about the Sage on Boston is that when you purchased it, it still allow you, as long as you occupied it, you were still able to purchase other properties. So I helped one of my clients purchase a condo at Sage on Boston. They're still living there, and they're in the process of getting pre-approved to purchase an investment property. So every deed restricted property does have different requirements. It's very important that you pay attention to that because some does not allow you to own, an investment properties and still live in a deed restricted property. But Sage on Boston was unique in this case, which if we have more properties like that, especially coming up in the near future, I would recommend that you hop on it because when they moved in the same where Sage on Boston, their mortgage was extremely low, right? Their interest rate was low at the time because they bought down their interest rate. They was able to, get some funding from the Boston Home Center, and that they use that to lower their interest rate. So they have a low mortgage, and they're going to be able to occupy this property and then still own investment properties, and they can purchase as many investment properties as they choose to, as long as they live in that condo.
And can you let them know how to access these properties, Erica?
Absolutely. So there's a whole bunch of lotteries that come up through the city of Boston, right? So when the lottery comes up, it's typically a link on the form or they have a website. You got to go there, you got to fill out the information, follow all of their steps from nuts to bolts, like submit the application. Sometimes they want ask for a tax return, whatever they ask for, you got to submit all of the information. And then once you're on the lottery, they'll select you, and sometimes you feel like you're not going to get selected, but their issues that they're having is people are not actually applying, right? Because even we got a Sage in Boston a little bit late and they still had openings. So just apply and there's an opportunity for you move into one of these deed restricted units.
You can join the wait list. Someone asked what Sage on Boston is.
So Sage on Boston was a development that was in Roxbury. It was a deed restricted condo development in Roxbury. I'm not sure how many units was there. I don't recall. Katia, you remember how many was there?
Oh yeah, 40 units. Yeah, Sage on Fountain. It was right over by oh my God. In Roxbury going towards my gosh, up the hill.
Yeah,
Yeah, great views of Boston.
families,
But
single,
yes,
single
safe.
bedroom, 2 bedrooms and 3 bedrooms, right? At the
Yep, you had studios, 1 bedrooms, 2 bedrooms, and 3 bedrooms.
yeah. And of
And
course, you apply for a unit that's based off of your household size.
Yes.
They're
Mhm.
not going to
and
give you.
I was just gonna say for those who might not know what deed restriction means.
So there's a restriction on the deed. The deed tells you that you own the property, right? And that's listed on public records. It's a restriction, and every restriction can be different, but basically you cannot resell the property at market rate. They restrict it because you got it at an affordable rate. So when you want to resell it, they're not allowing you to sell it at market rate. And that deed restriction can be for perpetuity, which is for a lifetime, or sometimes it can be for X amount of years.
Does that make sense to everyone? So these houses are at a discounted price with some restrictions. Any questions on that? All right, no questions in the chat.
And there's a
Yeah, go ahead.
So
Go
there's
ahead, Erica.
additional programs, grants that you could receive. Equity Builder One of my clients who purchased the house with no money down, she was able to couple a few programs together. And we actually just closed about 2 weeks ago. She was able to get some mass housing down payment assistance. She got some funding from somewhere else. And there's programs like Equity Builder and Workforce Housing where you can get additional funding to purchase if you're a first time home buyer. So there's always definitely qualifications for these programs. There's income limits that they basically state that if you make X amount of money, you won't qualify. If you have X amount of assets, you won't qualify. But if you do fit those categories in the requirements, you should definitely apply to get as much funding as possible.
And if I can add, that program, Equity Builder, How, and Lift, goes live tomorrow.
Hey.
Oh,
And I should point out it is first come, first serve.
how much funding do they have?
Well, they haven't announced. I mean, I haven't seen anything on what the initial allotment is for tomorrow. So what they did announce is they're gonna release money on April 1st, April 15th, May 1st, May 15th. It's like June 2nd and June 17th. So there's gonna be a total of 6 releases.
Mhm.
It is first come, first serve. You have to be under contract. They need 15 business days to process their paperwork. And to your point, you can piggyback it with you can piggyback it with mass housing, you can take mass housing, Boston Home Center, BHA, how you can piggyback it all together. I had a client last year that I was able to give up to $100,000.
Yeah, I was gonna ask you, working with, I know you work with so many clients, how much down payment assistance, the max amount have you got a client?
It was about 100,000.
Good.
It was in the city.
Crazy.
Some of them have, like you were saying, some of them have their own requirements. Some say you have to put $500 in. Some say you have to have 2,000. Like the city says you have to have 1.5%. So every program is different, but there's a way to piggyback them all together. It's a great feature if you can get it.
Love it. So most people think home ownership is out of reach, but as you can see, there's so many different programs that you can use. It's really about working with someone who understands the strategies, and we all do, and having a great lender who has these programs. Not every lender has the same program, right? You have to work with a real estate agent that's going to, gear you in the right direction. NACA has their own set of people that they use, and that's all in-house, right? When you go talk about the other programs, it's what lender has them. One Plus Boston, Mass Housing Down Payment Assistant, what lender has these programs. So don't think that you can't purchase a house because you don't have savings, because it is feasible. We have all helped clients purchase house and got a lot of down payment assistance. If you look at Thumbprint, oh, just over the years, the amount of down payment assistance that first time home buyers have received, the number is really high. So it is feasible.
Definitely. Any questions, anyone?
All right, cool. We're gonna roll on. So we're gonna give a real live example, right? Buying solo versus buying in a group, right? And a group would be you plus another human or more. And this just helps break this and make this real for you. So let's say you buy a $600,000 property, right? Roughly, let's just say that's about a $21,000 down payment, not including closing costs and any other fees, etc. On a solo, if you're buying a house by yourself, a single family, right? That's you coming up with all the cash. You need to have that in your bank account, in your 401k, a gift to a certain percent, but you got to come with it all. Typically, you don't have any income, right? It's just a straight liability, right? And this comes with a high debt to income now because it's just you. There's no additional income going to be received from acquiring this asset, right? This property. So it's a lot harder to get approved. And typically, what people are finding it challenging is to get approved for a certain amount. That's enough to buy something they like. That's enough for them to buy something in an area that they like. So what we're seeing a big transition to is group financing, right? That's where the co-borrowing comes in. That's where group financing and these other programs and avenues where now I'm taking that $21,000 down payment that would be required from this one human, right? 21,000 plus closing costs, let's call it 30. Now we're splitting that to 10,000, right? 10 and 10, 10 and a half. between two parties, and if we're buying a 2 to 3 or 4 family, we're acquiring this property that we could still rent out the other units, right? One of the borrowers live in one unit, one of the borrowers live in the other unit, and if there's a third or fourth, we rent those two out, and now those two cover a portion or majority of our mortgage. And then our remaining amount is a whole lot less versus you buying an asset by yourself and having to take on that full debt, right? So that's where these things come into play. And even if, let's just say it's you and another person and you buy a duplex, same situation applies, right? Your down payment is cut in half. Your monthly payment, you're technically making money now because you own an asset, and instead of you covering that full mortgage payment, let's just call it, it was $3,800 for the monthly payment. You're splitting that in half with the other person if you're buying a duplex, right? Or if y'all are buying a duplex and you're staying in the same unit because there's 3 bedrooms, like, hey, listen, we'll stay in here and rent out the top so someone else or the left or the right. It's still a strategic play. But you now buying it with that person allows you to get a property that can attract the rents that can make you guys money, right? And later on, you can choose to go acquire another property that's your primary, keep this one and rent it out. You could do it solo next time. You could do it with the same person because maybe it worked out. And that's where, again, let's not forget the other important factors that we talked about earlier. Introducing group finance and co-borrowing, you want to do it with someone who you vetted, right? Meaning, look at their life, look at the decisions they make, ask for the credit score, right? If we're gonna make a decision to go rock, I need to know who I'm about to walk these streets with. You know what I mean? And then obviously you're gonna draft up a contract. And I wouldn't say just let ChatGPT do it. Maybe the ChatGPT gets you started, it needs to go an attorney and because they're gonna think bigger and outside of the box. Now I know we have the resources that can, but it's important because y'all both could be aligned with the same mission, the same energy, right? Have the great scores, great income to do this, but understand people change, situations change. Like someone you brought a house with, you know, who knows? They can get married and choose to like, I don't want to live here no more. And you're like, well, I'm not moving, and you gotta pay this rent, and you just never know what can happen. So there's got to be consequences, rules. If this person does this, what's the consequences of that? Like you want to have all those things considered and put in there because it protects you, protects the asset, protects the other person as well. But these are avenues to consider, right? We just weren't taught these avenues of consideration, which again, my mindset now, I'll run a play with not with anybody, but I will run a play versus by myself any day. I'm very picky with who I would choose to go run a play with. I have to be. Like this is it's very important because there's just so many things that can go wrong. Not that you're planning for it, but you do need to plan for it, right? But you're obviously looking for the best. Did I have more? I thought I did. No, I didn't. Okay. All right. So now we're gonna throw you guys in a hot seat. You guys heard about some programs, ideas, strategies. You've been invited to different programs and lending options. Uh, throw out your questions, your scenarios, the ideas that are in your mind, the things that you guys been talking about at the dinner table with your partner or best friend that you just need some more meat on that idea. This is you guys' opportunity to throw it on us, and our job is to give back that value, give back that input or etc.
Someone asked, are there any products for people who already own a primary property, a four-family, and are looking to purchase another property? Are there any products for that scenario? Yes, we spoke
Heck yeah.
about it a little bit at the beginning. You can use conventional FHA. If you don't already have a FHA loan, you can only have one at a time. But you just won't be able to use any of the first time home buyer products.
Which is
That's
fine, but you could still, as long as it's going to be a primary property, you don't have to put down that 20% to acquire that second one, right? So you own a four family now, right? Let's say I'm gonna go get another four family. So now you can go get a pre-approval to go buy the other four family or three family as your primary, because that's going to be your intention. And then now this four family, they're going to look at the current income, and gotta hopefully you have it on your tax returns too. They're going to look at your current income on there, and then also the departing unit. So the unit you're living in but not getting income, they will calculate what is market rent as you leave. So now that debt will be taken care of and maybe have some overspill as far as additional income. So when you buy your other house, they're now looking at, all right, you have this debt, but it's satisfied, or this rental income covers this debt. which gives you more money to your buying power. So when you're buying the next one, your pre-approval will be influenced because of how much money you currently make at your job, or if this property is cash flowing already, meaning like, you brought it years ago and you're making an extra $2,000 or $3,000 net profit after all expenses. That income now carries over to your pre-approval to buy it next. But you absolutely can do
And I
that.
can actually give my own experience on that, because you mentioned a primary and then a four family or a multifamily. So one of my first properties when I purchased it at the time, it was probably about 11 years ago. I lived in it for maybe about 6 or 7 years. I was able to do what's called a cash out refinance and actually buy a multifamily house using FHA. I lived in that multifamily house for about a year and a half, 2 years. Um, but that's the perfect scenario right there. I was able to use the equity from my primary property at that time to do a cash refinance, to then take those funds to buy a multifamily property and basically house hacked. Same scenarios that we just gave, same situations using FHA. So depending on how long you've owned that home that you live in as your primary, that could be an option to refinance and use some of that cash to buy another property. If you don't have enough equity in it, um, you can still use FHA or conventional and put down that 3.5% or 5% if you have your own cash. So that's definitely an option as well.
And can I
All
just
right, so
add something to that?
yeah, go ahead.
So as I said earlier, right, a lot of lending has to make sense, right? So if you own a multifamily and you're going from a three to a two or a two to a single, that makes sense. That's the normal, progression that somebody takes when they buy property. If you're living in a two and you're going to go to a three and you're going to say that you're going to live in the three, that's when it becomes more of a challenge, right? It depends on the location, what not many people go from a two to a three. But again, there are certain reasons why you would do that. But again, you just have to kind of look at the whole thing. So you can go from a three to a two, two to a one, perfectly fine. 5% down to your primary home, 3.5 if you're doing FHA. And I think I saw another question here that talked about what if one person is a first time home buyer and somebody else already owns a home? Can you take advantage of the program? Yes and no. If you're doing a first-time home buyer program through Mass Housing or the one, both people have, who's ever on the mortgage has to be a first-time home buyer. If you're going to go in the co-purchasing program and you're buying a two-family and one person is a first-time home buyer and the second person's not, you can still use the program. It's just that the only one that's going to get down payment assistance from the city would be the person that's a first-time home buyer. That individual who's already owned the home and is not eligible, you can still do it. They just won't get any money from the city.
So
Oh,
we got
I
a
didn't
we
know
got
that.
a
That's good. That's
yeah,
good
we,
news to me.
we got a question here. So it says their husband is on the primary on the deed, and she's the second. Properties in her name. Does that restrict her? Which technically you own the property, right? Even though you don't technically on the loan, but both
If
parties are on the deed, even though the debt is on the spouse's name.
so, yes, technically, if you're on the deed, you're on the deed. You're a homeowner. They won't give you credit for a first-time home buyer program. There are some cases with mass housing where you bought a home with a spouse, you separated, you haven't lived in that address for at least 2 years, maybe a year. You don't make any payments. It's not on your tax return, but you're still on the deed. Mass housing will make exceptions in those cases. So if I had the proper paperwork, they would allow the individual to buy a loan, buy a home using their down payment assistance in their program. So there's always that one off that they take a look at. Okay.
Someone asked for co-purchasing. Do both parties have to be first-time home buyers?
No, again, you could both buy it. It's just that the first time home buyer would be eligible for down payment assistance. The person who's not a first time home buyer would not be eligible for down payment assistance.
Are they still making that agreement split though?
They don't.
They do.
You all the most important document for that program is the co-purchasing agreement. So if you're going to do it and the first time home buyer is only going to represent 30% and the other person's going to keep 70%, that's fine. The city would just adjust their down payment numbers to accommodate the percentages.
Mm-hmm.
Right, next is someone was asking, are you guys a fan of HELOCs or cash out refis? Absolutely.
Yeah. Like I said, I did a
HELOC,
cash out refi. It was the best decision I ever made.
Yeah.
just phenomenal strategies to use them in a HELOC. If anyone has a property with value, first off, a HELOC is like an emergency backup plan. Even if you don't have actually, if you don't have current intentions, that's the best time to get it. Typically, when you need it, it's maybe you're in a certain situation and that may
Yeah.
actually impact your financing. But a home equity line of credit, hands down, everyone should have that. If you have, you got to have obviously more than like they usually lend between 75 to 80. There are some lenders that will go up to 90 or 100%, but they're very rare and they're closing the gap. But if you have equity in between that gap of, I would say 80 and below, absolutely you should have a home equity line of credit. Like even if you have no plans, because it's like a credit card that just sits there. You don't touch it, you don't owe anything. Like you don't owe, like you may have an annual fee of $50, but you got access to 100, 200, $300,000 at your fingertips. If you need it, you take it. Interest only required payments, meaning like once, let's say I take 50 grand, my monthly payments will probably be like $200. Now that's interest only payments, right? It's a 10-year term. You can pay back let's say I pay back the whole 100,000 I took, it goes back to being available, right? It's like a credit card. It's a revolving door for 10-year draw period, but absolute huge fan of it. Huge fan.
Yeah. Obviously, too, as long as it makes sense, depending on what your current rate is. Again, like I know when I brought my multifamily, my interest rate was like 3%. So I probably wouldn't do it again, at least not right now. But if the numbers make sense and it was enough equity, that made sense to cover the mortgage and still be able to use it for what I wanted to use it for or what you want to use it for, that's what you have to look at, break that down.
And that's where we come into play, right? You got to tap into one of us to share and talk through those ideas. Because you may say, I want a refi, but the refi is going to be 6.5%. But let's say that 6.5% helps you acquire this other property or asset that's actually going to make you the money in the longer run, right? Because you decide to do, you know, some construction on a property with Kattia and her team. And now you brought this property and fixed it up, and now it's going to make you more money. So there's just so much more to unpack versus a yes and no, but they're phenomenal products. Phenomenal products. All right, what other questions? You guys can come off mute too. You can raise your
Someone
hand.
asked about VA benefits. Someone asked, can you purchase a second home with your VA benefits? If so, how much money do you need for the down payment?
Okay. So VA benefits are technically a one-time issuance. If you want to use it more than one time, you have to go to the VA and you have to submit some paperwork. And most of the time, they grant the waiver to allow you to use it a second time. But location of the property is going to be key. All right. If you've used it in, I don't know, Iowa, and you're coming here to the East Coast and you're going to buy in New England, they'll probably give it to you with no problem. If you live in Boston and you want to go and move down to Milton, that may be an issue. Okay, so you can always go to the VA and ask that question, and depending upon the answer would kind of dictate how we would do it.
All right, Janae, you got a question?
Yes, thank you. If you get approved for any of these different programs, are you able to, because I'm asking about turning a profit on a property, are you able to open something like a group home with high regulations like that? Do you understand my question?
So a group home. So that would be
Stuff
something
like
that
that.
a group home that would probably fall under the commercial side of the business. It's a little different animal. They're not 30-year fixed rates. They're typically 5-year adjustables. So your rate's going to be a certain number for 5 years. After 5 years, it would adjust. But most of the time in that type of lending, you always refinance after 5 years. So yeah, I mean, I guess you could take your profit, go buy a group home, but it's just a matter of what the commercial lending group is going to require for terms, what the spec sheets will look like.
I don't understand. You said take
if
your
that's what you
profit
were
and go buy
asking.
a group.
Are you
Say it
saying
again.
out one of your units? You want to rent out one of the units and turn it in?
Right. Like, let's just say I bought a 3-family property. I stayed in the finished basement and rented out the 3 units as a group home. Is that possible?
Can she just get a commercial insurance?
So yeah, you buy a 3-family, you're going to stay in the basement. So basically, you're going to be using it as a 4-family,
Oh, I don't
right?
know if I
Or
But
one
say.
I'm just
bedroom?
saying, based on that example, if you're taking the basement and you're renting out the other units,
Mhm. If I
we would
qualify for one of these products, could I do that?
So say if
well,
she
you
purchased
already
a 2-family, she lives in the basement, right? Can she rent out the first floor to a group home, or she has her own group home there, and just get commercial insurance? Home insurance.
so see, I don't have a problem with her renting out the unit.
Hmm.
I just don't know if I don't know the definition would be a group home because it's rent. So if it's $3,000 and it's coming from 4 different people, you would
Also,
probably have a lease with 4 different people on it for me to do it. You know what I'm saying?
yeah. So just get a lease with one,
Yeah.
right?
Yeah,
To break that down, most lenders to qualify, they want you to be able to show the lease. So
correct.
that's what he means by that. So if it's going to be a group home, if you're renting it by the room, then that means you have, say it's a 3 bedroom, that means you have 3 leases. They
Oh,
might have an issue with that. Is that what you're saying, Vinny?
Yeah,
Versus
so
have
it's not
one
as much
lease
that
with
it'd be
three
one
people.
lease with 3 names, right? So
Yeah.
because you get 3 bedrooms, so you do one lease for 3 individuals. The tricky piece is just so if you bought a 2-family, you lived in one unit, rented out the other unit to those individuals, that's perfectly fine. But if it was a case where it's kind of like a hybrid 2.5 type thing, where there's a smaller unit that you want to live in, then that becomes a little tricky just because of the definition of the house and how I have to classify it.
okay, understood.
Okay.
Perfect. Thank you for that.
Good
One more.
question, though.
There was another question here.
Let's see.
Oh, it's
Is it hard to go from a 2 to a 3? It is.
I
Very,
would suggest I think that's Alex that's typing. He said just buy the home and make it a group home. So I was gonna say if you used one of these programs such as, conventional or FHA and it was just a 3-family, you chose to live in one of the units, um, you can have your one of us, your agent, has to provide the lender with the rents. Um, so you can lease it out for maybe a year or so, and then later on turn it into a group home. So that way you don't have to deal with everything with the lender. Um, so that could also be an option.
Okay, heard. Thank you.
Risa, hands up. Talk to us.
Good evening. First of all, thank you all for taking the time out your busy schedules to share this great information and resources. I'm a new agent with Thumbprint Realty, and I would like to educate some of my first time home buyers regarding these programs and options that's available to them. I mean, to be honest, I can relate to living in BHA. I can relate to being on Section 8, and I still know a lot of my contacts that, live in BHA and on Section 8, and they're not aware of how you can use your voucher to get a mortgage. I just want to, let me know how I can like implement that to them and let them know like all the resources that's available to them. Thank you.
Teresa, I will say if you like, it's totally up to you. Feel free to reach out to me. I'd be more than happy to, go over all the different options that are available from, a program perspective for down payment and so forth. So more than happy to do that for you.
Thank you.
All right, cool. So we had another question that said, wait, but sometimes a wife is on a deed, but not as a borrower. Does that matter in reference to Lacey's question? So I'm assuming that was a question about a husband brought a house, wife's on the deed, but not the debt. Um, as Vinny said, I mean that you're an owner of a
Yep,
of an asset, so you could still purchase, but depending on how or what program you qualify for is going to be influenced by the fact that you're on the deed.
correct. If you're on the deed, you are a homeowner. and you lose your first time home buyer status,
Or just
except for that rare exception that I mentioned earlier.
jump off the deed, right? Just get off the deed
Yeah,
and
actually.
become,
Pretty
wait
much, yeah.
time for X amount of time to become a first time home buyer if you want down payment assistance.
Yeah,
Erica, say that again. Say that again. Clear your throat and then say that again.
Just remove yourself from the deed and give yourself X amount of time so you can be seasoned and be considered a first time home buyer.
and remember,
Oh,
your seasoning is 3 years.
dang, really? Even if you weren't on a debt, you just came off the deed?
It's just you're a homeowner. It's 3 years.
That's
Again,
why we do
Do they
what?
pull that up? Is there a way to pull that up
Marriage.
or
Like I said, they
something?
got to find the deed.
Yeah.
listen, they,
Yeah, I was gonna say
listen,
they gotta go research the deed.
they do. They
Oh
listen.
yeah, the
I'm
attorneys do,
telling you,
huh?
look, mass housing
Dang.
underwriting. They have systems that I don't even know exist. Right? There's things that they go in and they certainly go in. And in that case, if they saw something, they would do a deed search in the registries because again, everything's online. So it's just a matter of punching in a few keys and you can get all that information. So they do check.
That's what you say, Jeremy. Who? That ain't me.
It's a
I
hundred
like.
Nah, that ain't me. I, I got a I got a D in my middle name. That ain't me.
Oh, believe, and we've had that. We've had that come up, right? Parents, somebody's named after their father, middle initial is slightly different. We've gone down that road and we've had to, get the paperwork to show it and we've done it. So
Yeah.
yeah.
We got another question. Can you purchase a second home with your VA benefits? Um, and if so, how much money do you need for a down
I think
payment?
we already answered that one.
VA is primary only. Got to remember, VA is it's a great program. Veterans should get the benefits for everything that they do for us.
Mhm.
But it's not a program that was designed to acquire property, like multiple properties. It was to acquire your primary home.
But you can acquire multiple properties with a VA, right?
You can't do a VA loan. I'm not aware of it. I could be
So
wrong. There may be a second out there,
you
but I'd have
can
to double check.
you can. I had a VA client. It does depend on how much of your VA loan is left, and like you said, you do have to go back and revisit. And they'll break that down for you. But you can use it twice,
Okay.
depending on how much you have left.
But
And you're right. You can use it twice, but I don't know if you can technically use it as for a second home transaction.
Oh, second home. No, I think it still has to be a primary property. So
Yeah.
the client that I had, she was buying a second primary property. So
it
you
can't
can
be an investment.
use it again. Yep.
Correct. It would certainly not be. I mean, second home questionable investment certainly would be a no.
So
And
Mhm.
let's say I own a VA home, right? I have a VA property and I want to buy another property that's going to be my primary, but it's a multifamily. Is that possible?
You can do
Yeah,
it, but
that
you
was
won't
the
be able to
exact
do it under
scenario,
VA.
Jeremy.
Hmm?
I was just saying that's the exact scenario that my client had. She owned a condo and was sold her condo to buy a multifamily property using her VA loan again.
So you cannot hold, she couldn't like hold the condo, like, and
Well, I don't
decide
know if she couldn't hold it. She chose to sell it
to
because
use the
again, it's
funds.
based off
Yeah.
of how much is left of the VA loan.
Yeah.
So I'm
Got you.
not sure if she had to sell it, but that was the scenario. She used it to
It,
buy a multifamily.
it's always best practice if you own a home through if you have a VA mortgage now, it's always best practice to reach out to the VA, let them know what you're thinking of doing, and then they can walk you through the process and let you know
Yeah.
what's available and what's not available for you.
And if you wanna, well, we're probably gonna go over it, Jeremy, at the end. I was just gonna say, if you need help breaking these scenarios down, or if you're in a situation, feel free to reach out to one of us. We can help you with that. Our contact information. Sorry,
Yeah.
Jim, where you was
Yeah.
going.
Yeah, no, absolutely. No, you're right. I mean, we're talking about so much great stuff. And to be honest, it makes no sense for you to be in your head trying to answer these questions. It makes no sense for you to spend months trying to find this information or just go without it because you're like, I don't know, versus just using your resources. Pick up a phone, right? All of us, we build powerful networks for these specific situations. We don't have all the answers, nor do we need to, but we need to have the resources or know where to go, right? And we have that. But if you have these ideas, these situations, these visions, there's a solution for everything. Now, some solutions may require some time, right, to be seasoned, and some solutions are like, yo, we're ready to go. This is the move. But leveraging this powerful team it's a no-brainer. You're gonna get where you need to be way faster, right? And with high level protection. So yeah, like she said, we have our contact information here. It's not over yet. If y'all still have questions, come off mute, drop them in the chat. We put this time aside for you all, right? To pour into to really expand how you consider acquiring real estate. Toya, talk to us.
And Jeremy, did you want me to kind of explain the process as far as how we approve a loan and
Yeah,
what
absolutely.
we
If we
need?
have no if we have no questions, I think that'd be great.
Okay. So, we talked about a variety of different programs tonight. Every program, as I said earlier, is different. They all have their own requirements. Each one has certain credit score requirements. So if you're thinking FHA, the minimum credit score for an FHA transaction is a 580. If you're thinking Fannie Mae and Freddie Mac, they only require a 620 or higher. If you're thinking Mass Housing requires a 640 or higher. If you're thinking the One Plus or the One Plus Boston, that score varies from lender. You could see it as low as 640. You could see it as high as 680, depending upon the lender. So every program has its own credit score requirements. But the thing with lending, we all base our numbers off of the same income calculations. And what we do to determine how much money we can lend to somebody, it's a percentage of what they gross every month for earnings. So for an example, if you make, I'm just going to use a number just to make life easy for math. If you make $10,000 a month, that's $120,000 a year. $10,000 a month, your housing payment, which would be your payment for the mortgage, your real estate taxes, your homeowner's insurance, if needed, PMI. Okay. We add those numbers together. That becomes what we call your primary housing expense. Then what we do is we take your other bills because, to be debt free is great, but you don't have to be debt free to buy a house, right? We realize people may have car loans and student loans and credit cards, which is perfectly fine. We look at the minimum payments on each. We total those minimum payments and we add that to your housing number, which again is the principal and interest, taxes, insurance, and PMI. That number for mass housing can't be more than 45% of what you make. So basically, if you earn $10,000, that combined number can't be higher than $4,500 a month. If you're doing the One Plus or the One Plus Boston, that number can't be more than probably around 41%. If you're doing Fannie Mae and Freddie Mac, they go as high as 50%. And believe it or not, if you do FHA, they go as high as 57%. So that's basically how we determine if you make enough money to carry the mortgage that you're applying for. All right, because everything we do is gross. If we worked off net, nobody could buy anything in this country. The taxes and everything else, right? So everything is based off of gross earnings. Now, a lot of the things that I get, how long do I have to be employed? What happens if I'm self-employed? Can I change jobs? Okay. Minimum employment is 2 years. You don't have to be the same job, same company for 2 years, but you have to be employed for 2 years. The only exception to that is if you're coming out of school, right? If you graduate in high school or college, we get a copy of your transcripts. We can show that you left school, went right into work. That's perfectly acceptable. If you're self-employed, you need a 2-year history of self-employment. And, basically on self-employed, we base your numbers off of what you report to Uncle Sam for income. So if you look at your tax return and it says you grossed $100,000 in sales, but you told Uncle Sam your net income was only $20,000 a year, I got to use the $20,000 a year number.
Question, Vinny.
Yes.
What about if you do have 2 years of tax returns, but say we're in 26 right now, say in 2025, you had a medical procedure, so you was out of work for half of the year, right?
Mhm.
But 2026, you're back at work, you're gonna reach your cap, which can be 120,000. Will you still qualify to purchase a house?
So if you're self-employed, it's a little tricky,
Mhm.
right? So maybe the approach would be to take an average of 23, 24, and half of 25's income,
Mm-hmm.
right? Some underwriters will do that, right? Because of the circumstances.
Mm-hmm.
There is a guideline that's out there. And it really depends upon what Fannie Mae and Freddie Mac tells us because everything goes through automated systems. If you're self-employed for 5 years or more and you file 5 years worth of business tax, self-employed tax returns, be it Schedule C or corporate, right? I could get a response from Fannie and Freddie that says I only have to use the most recent year.
Gotcha.
Why is that important? Is because what happens if 24 you said you earned 40,000 and now in 25's return your net profit was 100,000. Well, if I average it, that averages out to be 70,000 a year. But if I get that use the most recent tax year, I can toss the $40,000 return out the window and I can qualify on the $100,000 return.
Mm-hmm.
Right. So those are the kind of little things. And I won't call them
Now you
tricks,
said
but
self-employment. What about if you're a regular W-2 employee?
if you're a regular W-2 employee, if you get paid by hour, we basically look at your pay stub. If you're working 40 hours a week and you're making $35 an hour, we do the math. We take the gross earnings times 52 weeks divided by 12.
So
If
even
you,
if you say even if the individual in 2025 they had half of the year off because of medical procedure, right? Are they still going to be able to qualify at that max income? They're back at work. They make 120,000 per year. Will they still be able to purchase at and get pre-approved at the current salary that
you could. That would be something where I'd have to get the paperwork and you'd have to write a letter explaining what happens. And I'd have to have the conversation with the underwriter because as a sales guy, they don't let me approve loans, right? I can do pre-approvals and stuff like that, but I can't sign off on anything, right? I have to have a person that's called an underwriter do that for me. So I have to talk to the underwriter and go over it, present the case. And if they feel comfortable making that determination to use that type of calculation, then that's fine. Because in our side of it, guidelines could, you can put the same guideline in front of 5 different underwriters. It's all interpretation.
Yep.
Right? Very vague, right? And underwriters will tell you if I can justify what I did, I don't have a problem doing it. Because if somebody ever came over to me and said, "Why did you make this loan?" I can go through and say, "Because I did this, 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 and this, and it all makes sense. And here's my explanation." And you're usually fine.
Now, Vinny, what programs do you currently offer so everyone knows that's on here?
So I currently offer the one, mass housing, FHA, VA, Fannie Mae, Freddie Mac. Being a bank, I have portfolio lending, which are in-house products. They give me some flexibility on certain things. I do Federal Home Loan Bank, the HOW and the Lift Up. Because I'm a bank and I participate with the Federal Home Loan Bank for other things, I'm allowed to use their programs. IMBs or independent mortgage brokers can't use that type of government funding because they're not a bank, they're not associated with that.
What about mass housing? Do you do?
I do a tremendous amount of mass housing.
Good.
Not to brag, but I will. I was one of the top lenders in Suffolk County
Rag, Vinny.
for mass housing for the last 2 years.
Rag for sure.
Okay. I do a tremendous amount of DPA lending. I tap into every program that's available because as we've been talking, you have state programs, you have city and town programs, you have federal programs. I can piggyback all of them together.
Love it.
So do a tremendous amount of that. And I think one of my biggest sellers, and I know we talk about co-purchasing, but if you buy something for $500,000 or below, I can get you into the house for $1,000.
Did y'all hear that? I don't think they heard you, Vinny.
Right? If you bought a so if you
Vinny
bought a
talking
piece of,
so good, I put on myself. Let me take
No.
down his
if
number
you
right
bought
now.
so if
Hold
you bought a
on.
single if you bought a single family for $500,000, I can take the mass housing down payment assistance loan. I can take the 25,000 that they give to you. I can take 15,000 to take care of your 3% down payment requirement.
Where's that 15,000 come from?
The mass housing's down payment assistance loan is 25,000. So I'm going to take the 25,000 that they give. I can take 15 away from that.
Okay.
That covers your down payment requirement.
Yep.
Right? That leaves me 10.
Mm-hmm.
The 10 will go to your closing costs.
Mm-hmm.
You could buy down the rate. There's probably enough money in there to buy down the rate.
Mm-hmm.
So I can take the 25,000 that they're going to give you, and I can cover everything. The reason why I say it's going to cost you $1,000 because you got to pay for the appraisal out of pocket, and you got to pay for your home inspection if you're doing a home inspection.
Mm-hmm.
So for $1,000 on a $500,000 loan, you can buy a condo or a single family, depending where in the state you want to live.
Love it.
This is exactly why you need to work with the right lender, the right team, the right agent.
And then if you want to go higher, you can, and you can buy someone for 600 and 700 on a single. It just means you gotta come up with probably $14,000, something like that. But your out of pocket's probably still going to be cheaper than if you were to go rent somewhere and have to pay 3 months worth of first security and whatever.
Vinny, if you was a first-time home buyer and there's a person who wanted to, purchase their first house and then move up to purchase a second house, what would you recommend?
So I would probably recommend, of all the programs, if I can make the numbers work, I would certainly recommend mass housing to start.
Mm-hmm.
And then I would just go, at that point, I'd go traditional financing for your next home.
And would that traditional be FHA? Would it be conventional? What would you do?
One of the three.
Okay.
FHA, Fannie Mae, Freddie Mac, just depends on the situation.
Gotcha.
Maybe your credit score took a little hit for something and you can't get to the 620. Don't let that stop you from, if you want to move on, move on. Just take the FHA loan and, when your score goes back up down the road, if rates come down, you can always refinance your loan. And that's probably one of the big takeaways, right?
Mm-hmm.
Yes, rates have creeped up a little bit. We do expect them to come down, but if you bought something today, when they come down, you always have the ability to rewrite the mortgage. Right? And then, depending on your savings, you can redo a 30-year mortgage all over again. There's nothing stopping you.
Mm-hmm.
Age is meaningless. You can be 80 years old taking a 30-year mortgage, right? That's not a problem. You may save enough on the rate difference where you may not want to do 30 years. Maybe you're comfortable making the payment that you're making today, right? But now, if you make that same payment, maybe I can take 5 years off the loan. So instead of giving you a 30-year loan, I give you a 25-year loan or a 20-year loan. So there's all kinds of different reasons to do stuff. So don't let, a rate start, you say, oh, the rates are too high. The rate is rate. If you like the house, you buy the house.
I love it.
I'm a big believer in that, right? Rate is rate. I've been doing this a long time. I did loans at 15%. Then they got to 12 and we thought that was the greatest thing. And then they broke 10 and it was like, oh my God, under 10%. I mean, rate and sales price usually go hand in hand.
And with conventional, you can use it over and over and over, correct?
Correct. No limit. As long as you're willing to rewrite it, you can do it as many times as you want.
Mm-hmm.
All right. So that's basically, and a couple other things like, deed restriction. We talked about that. Make sure whatever lender you go with, you let them know you're buying a deed restricted property. So that way they put you in the right program.
Mm-hmm.
Again, if you're going to use a Section 8 certificate, not a problem. Mass Housing allows it. Just so you know, it's not a problem with them. But you just want to let your lender know so they make sure they put you into the right program. And probably the only thing I can tell you about myself is we keep all of our loans except for 2 products. Mass Housing, because the state requires us to sell them the loan because you always make payments to Mass Housing.
Mm-hmm.
And FHA loans. We're not set up as an FHA servicer. But if I do a portfolio, a Fannie or a Freddie, you would always make payments to Salem 5.
Oh, that's good.
Yeah, we don't sell those.
That's good.
That's major.
Yeah. So I'm not sure if anybody else has any
Anyone have any
questions.
questions? Nothing.
Or comments?
There was a
Sitting back
question
like,
in the
whoa.
chat that I was answering from Monique. So she wanted to know what is the down payment and does it require income? I forgot to mention that I don't want to go off of income. She wanted to know what program she could use.
What is the down payment?
Where
Does it require income? Well, I guess those are 2 separate things. Your down payment, depending on
No,
the
Vinny,
program.
she wanted
I
to
think-
know what what loan programs aside from DSCR that she could use to purchase an investment property.
Oh, okay.
And does not need to own or occupy it. So I had told her she could use conventional.
Correct.
Mhm.
But if
So
she
anybody
doesn't
else.
want to base it off of income, then DSCR or hard money would be the only option if that's what she.
Correct.
Mhm.
Yeah.
Exactly.
Yeah,
Yeah.
you'd want something that just she's trying to get something where the house carries itself.
Yeah,
Yeah.
definitely.
But Monique, I'd be curious why exactly you want to do that is, we can talk about it offline, but, or unless you want to, say why, you only want to base it off of income.
Mhm.
Is it in a LLC? That's why.
Well, that's what I was curious about, if she wants to say. Oh, she said a friend,
Is she here?
A friend of hers was asking.
Okay.
Oh, okay.
Mixed use.
Mixed use.
You know, in my world, mixed use is acceptable as long as it doesn't exceed a certain percentage. You
Is
know,
it 50%, Vinny?
I last I checked, I believe it was 25, but
Okay.
I'd have to double check that. But as long as you're within the, you know, the Fannie Mae, Freddie Mac guideline, we can we can do mixed use. And if you exceed it, then we either go DSR, private lender, or commercial.
Sure, yeah.
DSR is a popular one. We're actually working on rolling something out. I'm hoping to have it by midsummer.
Nice. Okay.
Any other questions?
No. Thank you all.
No, a lot of good questions. I think this was great.
Yeah.
Good stuff. Well, shout out to you all. I share and follow up. Cool.
Thank you, Monique.
Yeah, the good thing is you all have our information. We're here as a resource and a whole team. So this was great. Shout out to the host. Shout out to you all, Thumbprint Realty, Vinny, great information. Kattia, Erica, Clorissa, great work. Thank you everybody for putting the time in, honestly, to pour in and add this value. Big time. So wait, last minute items before the meeting ends. Oh, that was, I don't know if that's
Is this,
AI. That's AI. Yeah, I think that's an AI jump off. But listen,
Oh,
blessings. The good part is you all were stimulated or got a different piece of information that you did not know before. Run with that information. Meaning, if you had intentions or plans or wants, and you heard something that interests you or maybe aligns with where you want to go or what you want to accomplish, do something with it. Right? Reach out to us, carry the conversation on, and we put you in the right position. Rather it's tomorrow, rather it's next week, or rather it's a year from now. Right? But it starts by getting clear, and then we can map out the strategy,
Love it.
and then we're gonna plan from there.
Toya asked if the flies would be available. Unfortunately, they won't be available. So definitely reach
But
out.
we're available, and we made the
We're
slides.
available, each and every one of us.
We made the slides, and we're available. We got you.
Yeah. Please don't hesitate if even if there's no such thing as a silly question. So don't hesitate to reach out, even if it's just to ask a question.
Yeah, there definitely is the thing of silly questions. It's just we won't judge you in public. You know what I mean? We're gonna keep that to ourselves. Nah. Good stuff. All right. Well, if there's no questions, you all have a blessed evening. Please do something with what you learned. Don't sit on this information and do nothing for another 6 months until someone else throws an event. Like, run with information. There's so many opportunities to win, despite what it looks like. So many opportunities to win. So let's win. Simple as that. Let's win.
Where
All
there's a
right,
will,
crew.
there's a way.
Right.
Damn right. There really is. It's just maybe a steep hill, but the hill's there.
Hey, we're
Do
gonna
the
figure
work.
it out. I've had
Yep.
clients who had to wait a whole year to buy, but we figured it out.
Yep.
Right?
That's the commitment mindset.
Strategy.
Shout out to the team. Good
Hey,
work, everybody.
Thank you, guys.
Thank
have a
you.
good one. Good night.
All right. Good night, everybody.